My name is Mingxuan. I'm from University of Chicago. Quick intro, I'm a quantitative researcher. I do mostly math and data research in DeFi and tokenomics. And for the past summer, I've been a research intern, fellowship, whatever we call it, at Nethermind, which is one of the Ethereum development and research companies. And this is partly what I worked on at Nethermind. Before Nethermind, I was a research analyst at Polygon, where I did more DeFi research. And I'm happy to talk about like LSDs because they've been very popular in DeFi, and a lot of people are doing research into it. But there are a lot of risk factors I think is a that requires communication with relevant shareholders in the ecosystem. So I'm happy to share about my research here. All right, so quick agenda. So I'll do a brief intro of Ethereum staking and liquid staking for those of you who are not too familiar with this emerging field. And for part two, I'm gonna provide like an economic framework and financial framework for analyzing LSDs, and especially do a risk analysis for liquid staking derivatives. And third, if we have time, I will walk through a case study using Rocket Pool, which is the second or maybe third largest liquid staking protocol today. So let's get into it. Quick disclaimer, not financial advice. I have no financial ties, and views are my own. And I will be sharing some research tools and sources throughout this presentation. If you're interested, you can do your own research according to those sources. So very, very brief history of Ethereum staking. It's only been a year on mainnet since the merge. So people know about the merge, right? So essentially, Ethereum switched from proof of work to proof of stake. And so now anyone can stake 32 ETH on mainnet and accrue rewards as a validator. We just heard another talk on this. So earlier this year, there's the so-called Shanghai Capella upgrade. Some people call it the Chapella upgrade. And this was a huge deal for Ethereum staking because it allows you to not only stake on Beacon Chain, which is where the staking contract lives, it also allows you to withdraw that stake. So it allows you to quit as a validator, essentially, or withdraw your rewards. Before Chapella, it was not possible. So as you can imagine, this opens up a lot of opportunity for potential investors and stakers who want to come into the space, right? Without fearing they're just gonna lose the money forever, their money gonna get stuck on the chain forever. Okay. So we've seen a lot of growth after this Chapella upgrade. That's why I'm partially seeing that it's a big deal. And I'll give you more data on this later on. Now, I want to kind of solidify the numbers of Ethereum staking. Typically, we say it's just like a 3.5% APR, or maybe 3.5 to 4 is a more accurate range, right? And but slightly more nuanced than that. So there are two parts of staking APRs, two components. So one component is the consensus layer rewards, which deals with everything from block proposal, attestation, so anything that has anything to do with Ethereum consensus itself, right? So it runs on the consensus client, basically. And the other component is execution layer rewards. So you have, first of all, transaction fees, gas fees that people are paying for their transactions, which was modified by 1559. And there's the other big part, which is MEV, which I'm definitely not going to talk about today, but it's a big part. So on the chart, you can see the APR breakdown from Lido's Doom page. So it's a pretty good representation of where we are right now. So the orange section is consensus layer rewards. Since it deals with consensus, it's fairly stable and it's not really, responsive to any market changes, reasonably. But the other part, which is execution layer rewards, is quite, it varies a lot from day to day. since the nature of the transactions vary a lot day to day. So this is something to keep in mind. All right, more data. Currently, there is approximately 22% of total ETH supply that is staked. It's not a huge number compared to like some of the other L1s. They have like crazy staking numbers, but Ethereum is more used, so it makes sense. The breakdown of sources of our ETH staked, the largest section is currently liquid staking at 37%, which is huge. And notice another like very big chunk, like around 20% is centralized exchanges. And some centralized exchanges also issue liquid staking tokens as well. So the actual number of LSDs market share is probably around 50%, I think, give or take. All right. Now, we mentioned liquid staking. Let's do a formal intro. So LSDs, or legacy derivative liquid staking tokens, whatever we call it, are ERC20 tokens that represent the ETH tokens that are staked in the staking contract of Ethereum. So here's a very like basic model of what most liquid staking protocols look like. So users will deposit their ETH with the protocol, which is typically a pool of some sort. And the pool would delegate 32 batches of 32 ETH to the node operator. The node operator runs the validator software, and they use that 32 ETH to run the software, and they stake that ETH on Beacon Chain. So that's how it works. In return, the protocol will issue LSDs, those ERC20 tokens, back to the user for their contribution to the ETH staking pool. And when the user gets the ERC20 token, they can do whatever they want with it, right? They can trade it on DeFi, like stake it somewhere else, not stake it, collateralizes somewhere else to get a loan from Aave. They can collateralize their trading portfolio on like a perpetual exchange, whatever they want with it, right? So that's how it works. And by trading it on AMM or any other application, other people will have access to this liquid staking derivative too. I'll explain later that it's a really interesting mechanism that they can do it. So benefits of liquid staking. So first of all, there's the return that you can get, right? And the second benefit, which I think is a bigger deal, is that most LSDs are retail friendly, meaning that you don't need that 32 ETH capital to stake your Ethereum and get the staking reward. So you can stake anywhere between, I think, for most protocols, it's like minimum of 0.1 ETH or maybe even lower sometimes. So it really allows a lot of retail users to enter the staking space and contribute to Ethereum consensus, which I think is a really good thing for the ecosystem. And the third thing is, as the name suggests, LSDs are liquid, right? So Ethereum staking itself is a lockup mechanism. So you can't really access that until you do the I explain how exit works, but you can't really exit until you go through the entire queue of exit and withdrawal and blah blah blah. So liquid staking derivatives solves that. And the use cases I kind of mentioned some of it, right? You can use it in borrow lending. You can use it to collateralize your trading portfolio, etc., etc. Those are the most popular use cases right now. People are exploring other options like LSD-backed stable coins and stuff like that, but those are still like in the idea phase or some are work in progress. So these two are probably the most common use case right now. I didn't mention this, but liquid staking derivatives are redeemable for ETH at any time. We will see when that is is not the case and why that will be a big problem. But for now, let's assume that LC is redeemable. And the last point I want to mention is a really interesting mechanism that's kind of unique to LCs compared to other DeFi tokens. So LCs accrue rewards automatically. Different protocols have different ways to implement this kind of automatic accrual. So, but in general, like holding LC tokens is equivalent to like staking ETH in the protocol itself. So when I say different protocols, I mean, for example, Lido. Lido has a one-on-one peg of their staked Ethereum with Ethereum itself. But how are they gonna like get the reward to users, right? They like literally airdrop the rewards to the user balance. Pretty much, they update the balance to reflect the number of rewards every certain time period they have. Some other protocols like Rocket Pool implement this differently. So Rocket Pool, RETH is their LSD. The exchange rate of RETH and ETH is not fixed. It's not pegged. It actually increases based on like how much time has passed since you stake in Rocket Pool. So, but in general, like all LSDs accrue rewards automatically in this sense. Now, I kind of mentioned this. So, the data shows that from April, which is when the Chapella upgrade happened, to I think this is end of August, right? We've seen huge growth for the LSD sector. It's currently the #1 DeFi sector, and Lido is currently the largest DeFi protocol right now. And it's like I think I counted it as like a 40% increase over like 5 months, which is kind of crazy. And as you can see here, this is from DeFi Llama, by the way. The blue chunk, which is kind of dominating market share, you could probably guess that it's Lido. So this is the current like landscape of the market. All right, now I want to pivot into some more economic analysis of LC protocols and like LC as an asset as well. So here's my own mental model. I think of LCs as similar to banks. So this might sound a little bizarre at first, but let me explain. So the economic definition of banks, they're in the business of doing the following. They're the financial intermediaries that create liquidity through the following two mechanisms. First, they gather liquid deposits from customers. That's what we do like with banks, right? We deposit with them, and we deposit cash with them. So that's liquid. That's a liquid liability. And what do they do then? They then invest those liquid assets in presumably bigger chunks into illiquid investment projects. So some of the common bank investments include like government bonds, corporate loans, and mortgages, right? Those kind of things, which is less liquid but generates higher return, and that's their assets. And isn't that what exactly LC protocols are doing, right? They gather liquid ETH from the depositors and hold them as liabilities, right? And then they invest those ETH in bigger chunks, namely 32 ETH, into Ethereum staking, and that's the asset they're holding. Right. So here's my mental model for LCs, typically. The good thing about this is that it allows a lot of research insights from TradFi, and even some cases Web2, to like enlighten the research of this very emergent, very new field of LSDs. I'll mention some of them later on, but here's the model. So the natural question to ask, that's what I did when I like kind of thought about this model, is how liquid are LSDs really, right? When we talk about like banks create liquidity, LSD protocols create liquidity, how much liquidity did they actually create, right? So I use this metric. I actually use two metrics. This one is called Amihud. It's from the finance literature. I don't want to go into it. But essentially, it measures the liquidity of an asset. And it's really nice to have this kind of quantitative measure because you can compare all the LCs together. Instead of just the depth of liquidity measure that we typically use in quote in DeFi. So this chart, the blue line is Ethereum itself, and the other ones are LSDs. So it's kind of interesting. Like there's not too big of a discrepancy, right? Obviously, LSDs are still less liquid than ETH itself. I think we can all agree on that. But it's actually not. It's actually pretty close, and we also see like a kind of liquidity hierarchy on this chart. So our ETH, that's Rocket Pool, is at the bottom. A little bit above it is Coinbase, and then Lido is kind of on the top, which I think like is consistent with most people's like mental models of how the competitive landscape is, right? And here's a similar chart, but this one is more like highly varied through time. This is another measure by BPW 2011, but basically the same chart just with different fluctuations. It's interesting that like Coinbase actually, flipped in a sense ETH itself in some time period back in April and May, which to me is really interesting to see. But I don't really have a good explanation for this. It's part of my ongoing research into liquid staking currently. All right. Now let's go back about this bank model for liquid staking derivatives. When we talk about banks in economics, the most relevant theory, I kind of alluded to this, but is Diamond Dybvig. If you don't know them, they are the Nobel Prize winners for last year, and they are also UChicago professors. Diamond is a professor at UChicago. Dybvig is not. And their theory specifically says about bank runs. So bank runs, as the name suggests, is when you have a bunch of depositors, a bunch of users run to the bank to get their funds out, to redeem their funds, because they fear that the bank may not be able to give them their funds back if they're late, for example. So they're gonna line up in front of the bank and yell or whatever to get their funds back. And I started to think, well, is the same thing possible for LLCs in this case, if they function so similarly as banks? And the very disturbing answer is yes. So bank runs are typically triggered by two things. They can be triggered by a sudden increase in demand for liquidity. In our case, there could be a liquidity shortage. For example, we might heard of the Curve event. I think it was July, right? It was July when a bunch of liquidity pools were drained, and liquidity was on a shortage, right? So that could trigger a bank run. And another reason for why you want ETH instead of LSD is just the price dropped, and you want to just get out of this ETH investment entirely, right? That's a reasonable reason. And there's also like regulatory concerns, like if say the the SEC comes in the room and say, guys, we now declare liquid staking derivatives as securities because they accrue rewards and blah, 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 right? What do you do with them? I think many people will want to dump LSDs in that case. So that's a concern too, right? And another thing that could trigger a bank run is the expectation of insolvency. This is more serious, but it could also theoretically happen to LSDs. So, a thing we've seen in the past is all kinds of bugs and hacks and exploits happening to protocols. And when protocols lose that chunk of fund, they may not be able to pay back their depositors. So that's a real risk in DeFi specifically. We've seen a lot of those. So I think by 2023, people won't, just very idealistically assume it wouldn't happen, right? Because it will. And the other possibility is that there's large-scale slashing or penalty of validators. Slashing happens when a validator does something that the system doesn't like. So basically, like if you hurt Ethereum consensus in any way, you'll get slashed. That's the short explanation for it. Right? So these can happen. So what happens during a bank run? What happens if you have a line of customers line up at your door wanting to withdraw the ETH? Right? There are two main methods of how those customers can get the funds back. So the first method is through direct redemption from the protocol, like we see in the charts, right? And the second method is actually through DEXs. They can trade the LSDs back to ETH for like AMM pools, aggregators, whatever they want. Yeah. And what happens after these run out, right? Then the protocol will have to withdraw from those investments, aka they have to withdraw their funds from the beacon chain. And that's very hard to do because there's currently a churn limit of, I think they just updated to like 11 or 12, like last week, literally. So the execute only allows like a very small percentage of validators exiting every day. So it will create a queue in the execute. And after the execute, you have to go through another thing called the withdraw queue, which is how you get your funds actually back into your wallet. And this is the same queue as the partial withdrawals, so the people who want to only get their rewards back. But full withdrawals are processed much slower than partial withdrawals. And this is data from Rated. Currently, the withdrawal queue is 7 days, and execute is very short because nobody is really exiting right now. But you can imagine, like in a bank run scenario, right, where everyone want to exit, they're gonna queue up. They're gonna queue up, similar to like what the activation queue is currently at, which is 24 days. And they have last resorts. So in that case, what do they do, right? What the protocol do? They could pause the withdrawals, which I know it's not pretty looking, but they could do it. Lido currently has a so-called bunker mode that they will activate in the case of large slashing and some other concerns, right? And they could also choose to sell protocol equity. So for example, most protocols will have a governance token. They could choose to sell that from their treasury. But beware, this might cause what we call a self-fulfilling prophecy of insolvency, right? So in DeFi, people call it death spiral. So when imagine a bunch of DeFi degens see you are selling your equity to meet the withdrawal demands, it's a very bad look. So people will dump on you, and bad things will happen, even if initially it was just a small gap between liquidity. Right? So this may cause insolvency. What's missing here is actually what banks do, why banks are safer, right? And that is insurance. So we don't have that kind of FDIC insurance mechanism in DeFi. So this is the only tools in their toolbox, practically. I will skip the systemic risk. We're kind of out of time here. I want to just end here and ask if you guys have any questions.
Any questions for our speaker?
I don't have a question per se, but could you talk to that first point a little bit more about Nethermind and Lido collaborating to address that centralization? Or is that too deep of a topic to.
I would definitely be able to be happy to chat about this afterwards. It's a pretty big project that we just finished for Lido DAO. It takes us like a few months to do that, and I've been on this fellowship for 3 months and worked on it pretty hard and pretty deep into a lot of those fields. But this is something that is still work in progress, and I think a lot of people are criticizing Lido in the right way, and this is a part of a solution that we are addressing those criticisms. Yeah, so I'll be happy to chat about it afterwards.
Okay.
All right, thank you all so much for listening, and I'll be at the event until end of the day, and I'll be happy to chat whenever. All right, thank you.